Well, it's a big week ahead on the data front with JOLTS, manufacturing ISM numbers, and of course Friday's jobs report. But arguably, it's Fed Chair Jay Powell who will steal the market's attention, of course, on Wednesday. Now, he gives a final speech before the blackout period. He's expected to cement a slowdown in the pace of hikes. But my next guest says that doesn't necessarily mean a pivot. Joining me now is Jordan Jackson, global market strategist at JP Morgan Asset Management. Good to see you, Jordan. So break that down for us, because obviously there's a lot of nuance that people will be watching for in what we hear from Powell and a lot of the Fed speakers this week.
Sure. I think on tomorrow, the chairman is going to solidify smaller rate increases, but that doesn't mean an end to rate increases. We very well could see, at the very least, the Fed hiking rates over the next two meetings. So that's their December meeting, as well as their late January, early February meeting. But they could also be hiking very well into their March meeting as well. So over the next three meetings, again, they're more or less just shifting from a 75 basis point or 3/4 percentage point increase down to a 50 basis point, we think, in December, followed by potentially a string of 25 basis point increases over the first quarter of next year. You've also had some recent chorus or Fed speech suggest that rates might need to be north of 5%, right? And so that would maybe suggest a string of 50 basis point increases. So I think the markets are sort of welcoming these smaller increases, but we're certainly not out of the woods yet for higher interest rates.
And we have seen the market surprised a number of times, sort of jittery right before we get these announcements and then exuberant, and then all of a sudden the panic sets in again. How do you think the markets are pricing in the risks at the moment?
Well, I think the markets are maybe sort of trying to balance, right? How far the Fed is willing to go. Do they go to 5%, right? Do they sort of stick maybe slightly shy of that 5% level and maybe go to 4.75% on the Fed funds rate? I think the markets are still pricing in something to the tune of around 100 basis points of cumulative tightening over this quarter and through the first quarter of next year. That again would suggest a 50 basis point move in December, followed by 25 in February and in March. And so the markets are sort of appreciating maybe the Fed being a little bit hawkish, but depending on, we get labor market data happening on Friday. That'll be the last employment report before the December meeting. A very, very strong jobs report could very well situate the Fed to potentially deliver more rate increases than what the markets are currently expecting. And so, again, it's just difficult for me to see an environment in which the Fed feels they're comfortable in at least pausing, particularly given that you still have inflation running north of 7%.
And Jordan, when you talk about the labour market there, and we saw with the labour participation rate, what is this saying about the effectiveness of the Fed when you look at what's happening with the labour market?
Well, the Fed is in a difficult position because we're still in this environment of excess demand for labor, right? Close to 11 million job vacancies, 6 million folks unemployed. So there's this pretty big gap in terms of the demand for labor. And what the Fed is really trying to orchestrate is bringing down that roughly 5 million job vacancy gap in a way in which that doesn't meaningfully push up the unemployment rate. We anticipate that the unemployment rate is going to bounce around between, call it 3.5% to 4% through the first quarter of next year before you start to see the unemployment rate tick up modestly over the back half of next year. And so this excess demand is going to take some time to work out. Really also what the Fed from a labor market perspective is they're particularly worried about wage inflation. And so if they can effectively bring down this excess demand for labor, that should cool the wage inflation numbers and helping to cool down a lot of the core inflation prints as we start to move over the course of next year.
And obviously, you have this reduced spending power for consumers. Consumer confidence will also be coming out. What does this actually tell us about the state of the consumer when you factor in things like mounting debt and different ways that they're spending, not on discretionary, they're sort of putting some of these things on credit cards. And it does seem to have an air of desperation at the moment.
Sure. The way I would think about it is I think consumers are sort of normalizing their credit spending patterns, not necessarily becoming overextended. If you actually were to look at revolving debt as a percentage of disposable personal income, prior to the financial crisis, that number was around 9%. Coming into prior to the pandemic, that number was right around 6.5%. But we're seeing that number climb right to around 6%. And again, I don't think this is a sign that consumers are necessarily overextended. There are a couple of other additional tailwinds that may be hitting the consumer over the first couple of months of next year. One, you're going to get an 8.7% Social Security adjustment, one of the largest adjustments, COLA adjustments that we've seen going back to the early 1980s. The current administration is also talking about extending the student loan payments. So dual support there for consumers. And if we are still in an environment in which wages, at least nominal wages, are maybe trending lower, but still running to the tune of around 4.5%, 5%, we could be in an environment in which real wage growth potentially turns positive by the second quarter of next year. So the consumer still seems to be in decent shape. We're obviously watching some of the retail sales numbers over the holiday season to see if that trend continues. But it does seem like the consumer is potentially going to be the bright spot in keeping growth afloat over the next couple of quarters.
And we know that the Fed is saying the likelihood of recession continuing to grow. And as we take a look at what the bond market is indicating, do we have a sense of how deep a recession might be, or if the Fed will be able to pull off a soft landing and avoid a recession?
Sure. Well, one of the favorite indicators is the yield curve, the shape of the yield curve. And right now you have a very deeply inverted yield curve by measuring the difference between the yield on the 2-year and on the U.S. 10-year Treasury. That certainly has been a pretty good indicator of a recession in the past. However, the depth of the inversion has never been a decent indicator in terms of determining the depth of the recession. We're still in the camp that that the recession is going to be relatively mild, maybe a bit prolonged, lasting a few quarters, but still a relatively mild one. And we actually think, again, one of the bright spots continues to be the labor market and the consumer. Maybe most of the weakness actually materializes in sectors like the housing market, as well as in overall business capex. So again, we're still in the camp of a relatively mild recession, even though the bond market may be signaling something, maybe a worse outcome.
Well, great to get your insights, Jordan Jackson there, global market strategist at JP Morgan Asset Management. Thanks so much.